The silver market has just gone through a phase that, if viewed purely through an emotional lens, many would label a crash, a capitulation, or even the end of a story that had been heavily promoted for a long time. Silver is currently trading at USD 87.56555, a level low enough to unsettle those who entered near the highs, yet significant enough to force long-term silver observers to pause and ask a more fundamental question: what actually just happened? Within a short period, silver moved through all the familiar stages of a major volatility event: an aggressive rally, a break above technical levels long regarded as firm resistance, followed by a sharp reversal that unfolded at a pace too fast for many position structures to adjust. However, the defining feature of this episode is not how much prices rose or fell, but how large pools of capital behaved once the market slipped into a state of imbalance. What matters is not the magnitude of the move itself, but the direction in which the market structure is now evolving. Looking back at previous corrections in silver, especially during overheated bull phases, we typically see a familiar script. Prices surge, speculative capital ramps up leverage, media narratives begin to emphasize symbolic price targets, and then a single adverse macro or liquidity signal triggers a pullback. Large capital steps aside, confidence erodes, and it often takes considerable time for trust to rebuild. This time, however, there is a critical difference. Even as silver posted one of its sharpest daily declines in decades, the world's largest silver ETF, iShares Silver Trust, SLV, executed a move that cannot be dismissed lightly. On February 2nd in Sachs, the fund deployed nearly USD 3 billion to purchase approximately 500 tons of silver. This was not merely a large transaction, it was the largest single-day purchase in the fund's history. To grasp the significance of this action, it must be placed in the context of capital flows. The volume of silver acquired by SLV on February 2nd effectively matched the total amount the fund had sold since the beginning of the year. In other words, in a single day, SLV completely reversed its prior outflow position. The fund now holds more than 16,500 tons of silver, with an estimated total value of roughly USD 44 billion. Prior to this aggressive buying, SLV had recorded 7 consecutive sessions of net selling. As silver prices surged toward recent highs, only pausing at the very end of January. The timing is crucial. The fund stopped selling precisely as silver began to show signs of weakness, and then moved decisively to buy during one of the deepest single-day declines in decades. This is not the behavior of retail or sentiment-driven capital, but a clear signal of a structurally driven bottom-fishing strategy as the market searches for a new equilibrium. Turning to the current price reality and market structure, the first task is to anchor expectations to facts. A price of USD 87.565 must be evaluated relative to nearby reference points. Compared with the recent peak, this represents a decline deep enough to trigger a wide range of defensive mechanisms across trading systems, from automatic stop losses and margin calls to forced liquidation of highly leveraged positions. Relative to the most recent pre-rally lows, however, prices remain higher, indicating that the broader bullish cycle has not been fully invalidated, even though the upward structure has clearly been damaged. When viewed through a historical lens, the speed of this decline stands out as notably faster than in typical corrective phases, particularly when compared with gold. Over the same period, silver fell more sharply and more rapidly than gold, underscoring silver's greater sensitivity to liquidity conditions and speculative capital flows. Intraday and weekly volatility further reinforce this picture. Trading ranges have widened significantly, with large swings reflecting intense tension between forced sellers exiting positions and emerging buyers stepping in at lower price levels. Market reactions to news flow are also telling. Previously, even modest positive news could propel silver sharply higher. Now, favorable developments fail to generate proportional upside, while negative news is amplified. This asymmetry is a classic hallmark of a market undergoing structural rebalancing, one where sentiment is no longer the primary driver, and liquidity and positioning dominate price behavior. This section does not attempt to forecast outcomes, but the market's reactions alone speak volumes. When analyzing capital flows and behavior, the core question becomes who is acting and how. During the recent sell-off, short-term speculative capital and highly leveraged positions were clearly the first to be affected. The speed of the decline forced many positions to close, not because of a change in conviction, but because margin requirements could no longer be met. This resulted in passive, mechanically driven selling pressure concentrated over a short time frame. In contrast, longer-term capital, particularly that linked to physical silver and large institutional vehicles, began to appear on the buy side. SLV's actions are a prime example. Its large-scale acquisition of physical silver amid market panic highlights the stark behavioral divide between holders of physical metal and those exposed through derivatives or ETFs for short-term trading purposes. Physical silver holders generally tolerate price volatility better, as they are not subject to daily margin pressure. Large ETF managers operate according to asset allocation and portfolio rebalancing strategies rather than purely chasing short-term price moves. By contrast, leveraged participants are the most sensitive to volatility and often become the source of forced supply during sharp drawdowns. Silver mining equities face a dual impact, from silver prices themselves and from broader equity market conditions, capital costs, and profit expectations. The prevailing psychological signal is therefore mixed. Localized panic among leveraged players, hesitation among smaller ETF investors, and relative composure among large institutions. This suggests the market is in a transitional phase of the cycle, where weaker hands are being washed out and ownership is gradually shifting. Moving to the latest influencing factors, it is essential to separate them into three categories. On the macro side, interest rates and expectations around monetary policy remain the foundational drivers of precious metal sentiment. The US dollar, while not always inversely correlated with silver in the short term, continues to play a critical role in pricing and cross-border capital flows. Inflation and inflation expectations underpin the long-term silver narrative, but in the near term, central bank policy signals dominate market reactions. From a financial market perspective, equity volatility, margin dynamics, liquidity stress, and episodes of forced selling have all contributed to spillover pressure on silver. When cash is urgently needed, silver, owing to its liquidity, is often sold to raise funds. From silver's own supply-demand standpoint, industrial demand, inventories, and the actions of large funds remain pivotal. Any emerging divergence between paper silver and physical silver prices would be a key signal of systemic stress. Within this multi-layered backdrop, SLV's nearly $3 billion purchase cannot be viewed as random. It reflects a reassessment of the entire market structure, where prices have fallen to levels deemed attractive relative to long-term value, while technically driven selling pressure appears to be waning. This is not a declaration that prices will immediately reverse higher, but rather an indication that a major segment of capital has begun operating under a different logic than the rest of the market. From here, constructing forward scenarios becomes a necessary exercise, not to predict a single outcome, but to prepare a disciplined framework. A recovery and trend continuation scenario requires the exhaustion of technical selling pressure, sustained bottom fishing flows, and no further deterioration in macro conditions. A sideways, consolidative scenario is often what markets need after a major shock, allowing remaining supply to be absorbed and confidence to gradually rebuild. A deeper downside scenario, while undesirable, must still be considered should macro conditions worsen or system-wide liquidity tighten further. The key point is that each scenario has its own internal logic, and none carries absolute certainty. Continuing with the forward-looking framework, it is essential to emphasize that these scenarios do not exist in isolation. They can transition into one another depending on how underlying factors evolve. In a recovery and trend continuation scenario, the first necessary condition is a clear weakening of technically driven selling pressure, particularly forced selling from leveraged positions. When price volatility begins to compress after a period of violent swings, it is often a sign that the bulk of distressed supply has been absorbed. The next layer of confirmation comes not from commentary or forecasts, but from the observable behavior of large capital, specifically the ability and willingness to sustain net buying at lower price levels, similar to what was seen with iShares Silver Trust, SLV, during the February SEC session. In this scenario, the primary beneficiaries are not short-term profit seekers, but longer horizon holding structures, where volatility is treated as an inherent feature of the cycle rather than a trigger for emotional reaction. A sideways, range-bound scenario is often what markets require after a major shock. When prices fall rapidly to a level where sellers begin to hesitate, yet buyers lack sufficient conviction to push prices materially higher, the market typically enters a consolidation phase with narrower trading ranges. Why does the market need time in this case? Because positioning needs to be restructured. Those who were forced out are already gone, but remaining participants need time to reassess risk, especially in an environment where macro signals remain ambiguous. This sideways phase carries different implications for different participant groups. For physical silver holders, it is a period where price fluctuations exert less psychological pressure than during a sharp sell-off. For silver ETF holders, fund structure and flow dynamics become more relevant than spot price action. For those who previously relied on leverage, this phase often forces a reassessment of approach if they intend to survive the longer cycle. A deeper downside scenario, while not widely desired, must still be considered seriously. A renewed decline would not necessarily reflect a deterioration in silver's fundamental story, but could instead be driven by external shocks, such as tighter liquidity conditions, heightened volatility across global financial markets, or abrupt shifts in monetary policy expectations. In such a scenario, the most severe damage is typically borne not by simple asset holders, but by structures heavily dependent on leverage and short-term funding. The key question is not whether this represents risk. Risk is always present, but whether it constitutes a necessary cleansing process. History suggests that many durable uptrends only truly begin after the weakest structures have been flushed out. When segmenting silver holders and defining appropriate mindsets, the first step is to recognize that each group faces a different type of risk. For physical silver holders, the critical variables are not daily price movements, but the stability of market structure and access to liquidity when needed. The primary mistake to avoid in this phase is reacting to short-term volatility while losing sight of the original rationale for holding. For silver ETF holders, structural risk lies in understanding what is actually being held, how the fund operates, and whether inflows and outflows accurately reflect physical supply-demand dynamics. ETFs offer liquidity as an advantage, but that same liquidity can draw investors into sharp swings. For leveraged participants, the market has delivered a clear reminder of risk limits. Not every scenario allows time to correct mistakes, and when liquidity disappears, leverage can shift from a profit amplifier to the direct cause of losses. For silver mining equity holders, it is essential to understand the distinction between metal prices and equity prices. Mining stocks reflect not only silver prices, but also capital costs, operational efficiency, and broader equity market sentiment. Common misconceptions about silver become most dangerous during periods of intense volatility. The belief that a sharp decline means the end of the silver narrative is an oversimplification that ignores the cyclical nature of commodity markets. Equating ETFs with physical silver is another frequent mistake, as the two instruments serve different purposes and carry distinct risks. Many assume leverage is only dangerous during downturns, whereas in reality, risk often accumulates silently during rapid rallies. Similarly, the notion that silver equities always track silver prices overlooks the fact that equity markets have their own drivers, which can at times diverge completely from the underlying metal. When stepping back to view the full picture, What the silver market is signaling today is not contained in any single price point, but in the shifting structure of ownership and capital behavior. The most important takeaway is to clearly understand what you are holding, why you are holding it, and how much risk you can realistically tolerate. Markets do not require perfect predictions, but they do demand a clear understanding of the instruments being used. Markets do not destroy participants because they are wrong, but because they do not fully understand the tools they are employing. For those following silver with serious intent, continued observation of capital flows, particularly the actions of large institutions during volatile sessions, will be far more valuable than attempts to call exact tops or bottoms. If you are approaching silver from different angles or have specific concerns about risk in the current environment, asking questions and exchanging perspectives can help clarify the broader picture rather than allowing emotion to dictate decisions. From here, constructing forward scenarios becomes a necessary exercise, not to predict a single outcome, but to prepare a disciplined framework. A recovery and trend continuation scenario requires the exhaustion of technical selling pressure, sustained bottom fishing flows, and no further deterioration in macro conditions. A sideways, consolidative scenario is often what markets need after a major shock, allowing remaining supply to be absorbed and confidence to gradually rebuild. A deeper downside scenario, while undesirable, must still be considered should macro conditions worsen or system-wide liquidity tighten further. The key point is that each scenario has its own internal logic, and none carries absolute certainty.